Micro futures might seem like a great way to trade with low capital, but they could be silently draining your gains and turning a profitable strategy into a losing one. A lot of traders start with micros because they think it's the safer, more affordable way to get into futures trading. But what many don't realize is that the hidden cost of commissions can drastically reduce your profitability, especially if you're an active trader. The main issue? Commissions don't scale down in proportion to the contract size. At first glance, micro contracts are just a fraction of a standard mini contract. Take the ES mini futures, which track the S&P 500. One mini contract is $50 times the index price, while a micro contract is one-tenth of that, or $5 times the index price. This means that one tick in a mini is worth $12.50, whereas in a micro, it's only $1.25. Sounds simple, right? But here's where things get tricky. While the contract size is smaller, the commissions don't decrease at the same rate. Let's take a closer look at how commissions impact your trades. We analyze the fee structures of a low-cost futures broker and a well-known funding firm to get a realistic comparison. For many futures, a round turn, buying and selling one contract, costs around $3.80 with Teton, $4 with CQG and Rhythmic, and $4.08 at a funding firm. Since one tick in a mini contract is worth $12.50, commissions eat up about 30% of a single tick's value. This means that for every tick gained, you can scratch more than 3 trades before going negative. That's a pretty reasonable cost for active traders. Now let's look at the micro contracts. The numbers tell a different story. The round turn commissions for micros are $1 with Teton, $1.20 with CQG and Rhythmic, and $1.64 at a funding firm. Since one tick in a micro is worth $1.25, commissions account for 80%, 96%, or even 131% of a tick's value. This means that if you're scalping, you can barely cover one scratch trade per tick gained. If you're trading with a funding firm, you actually need at least 2 ticks just to break even. So while it might seem like you're risking less per trade with micros, the reality is that you're being taxed heavily on every transaction. Think about what this means in practice. If you're trading mini contracts and scalping for a couple of ticks, you have some breathing room, your commissions take up a fraction of your profits. But if you're trading micros, you're constantly fighting just to stay above water. You don't have as much room for error. This is a huge issue for scalpers who rely on heavy trading. Imagine you take 20 trades in a session, making small profits here and there, but the commissions eat into every single one of those trades. Over time, this can turn what should be a profitable strategy into a losing one. And here's the kicker. Because commissions aren't proportionally lower, the more trades you take, the worse the problem gets. The moment you start factoring in spreads, slippage, and execution speed, things get even more challenging. If you still want to trade micros, there are a few ways to reduce the damage. First, using Teton for order routing is your best option since it offers the lowest fees. Another strategy is to negotiate better rates with your broker or prop firm. Many traders don't realize that if you trade high volumes, you can often ask for lower commissions. If you're consistently trading micros, reaching out to your broker could make a big difference in your bottom line. Another common approach is to scale in and out of positions using micros instead of minis. Some traders who have the account size to trade 1 or 2 mini contracts prefer to trade 10 or 20 micros instead, allowing for more precise position sizing. While this flexibility is useful, it comes at a price. One mini contract costs around $4 in commissions, while 10 equivalent micros cost $12. That means you need 3 times the profit just to cover commissions. The question is, does the flexibility justify the cost? For some traders, yes, but for most, the extra cost outweighs the benefits. Despite their flaws, micro contracts do have some advantages. They've made futures trading more accessible than ever, especially for smaller traders who don't want to commit large amounts of capital. If you're using micros as part of a long-term investment or portfolio hedging strategy, they can work well. They allow small investors to gain exposure to commodities, treasuries, or hedge beta risk without needing large amounts of capital. Another great use case is for new traders transitioning from simulation accounts to live trading. While simulated trading is great for learning market structure and developing strategies, it doesn't prepare you for the psychological aspect of trading. Losing $100 on a real trade, even if it's a micro contract, can feel completely different from losing virtual money in a demo account. Trading micros with real money, even in small amounts, forces you to manage your emotions and develop discipline. But again, commissions will still take a bite out of your profits, so it's important to factor that in. On the other side, additionally to the already mentioned scalping strategies, micros are a terrible choice for spread trading. Spread traders rely on exploiting small mispricings and hedging exposure between two opposing positions, which requires high contract volume for the trade to make sense. If you're only trading 5 micros, the cost structure just doesn't work. We talk a lot about how shorter timeframes offer more opportunities for traders. The longer you hold a trade, the more you expose yourself to unexpected market events that can disrupt your strategy. Hedge funds and market makers are constantly adjusting positions in the S&P futures market, creating short-term inefficiencies that traders can exploit. For example, hedge funds use futures to hedge market beta, neutralize long-short exposure, or trade the basis in treasury futures. Market makers are constantly hedging gamma exposure from options trades. These participants create liquidity, but they also create temporary mispricings that active traders can take advantage of. Futures rollovers are another great example. Every quarter, large funds have to roll their positions from the expiring futures contract into the next available contract. This creates temporary price distortions that skilled traders can use to their advantage. But to capitalize on these opportunities, you need to be efficient with your execution, and paying high commissions on micros makes it much harder to profit. While micro futures lower the entry barrier for trading, their high commission impact makes them less ideal for active strategies. If you're scalping or spread trading, minis are the better option. However, if you're looking to hedge, balance a portfolio, or transition from simulation to live trading, micros still have a role to play. So, what do you think? Do you trade micros? Have commissions impacted your profitability? Let us know in the comments. And don't forget to like, subscribe, and turn on notifications for more trading insights.